Hi everyone, it's me again, Peter Harris, of Commercial Property Advisors and author of this book, Commercial Real Estate Investing for Dummies, and coach and mentor to many commercial real estate investors all across this great nation of ours. The topic and subject of today's video is called Office Building Investing for Beginners. So let's get started. I'm going to share with you 9 very different but very important topics concerning office buildings if you're a beginner. Number 1 is why invest in office buildings. I have 4 very compelling reasons to share with you. Number 2, the one big difference between investing in office buildings and residential real estate. Number 3, office building basics. These are just things that you just have to know, especially if you're even thinking about or considering investing in office buildings. Number 4, the different types of office buildings. There are basically 3 types, and I will break them down for you. Number 5, key terms. There are basically 10 key terms that distinguish office buildings from other types of investments. I'm going to share those with you. Number 6, the ABCs of leases. Leases are the lifeblood of any office building investment. Very important that you understand what they are and how they're constructed and how we use them. Number 7, things to watch out for. Pitfalls. I'm going to share with you several pitfalls and how to avoid them. Number 8, I'm going to share with you, which is probably the most important thing when considering leasing to a tenant. Very important. And lastly, the future of office buildings. Do you think they're going to be around in the next 10 years? Well, I'm going to share with you what I see as what the trends are, the top trends today. Okay, so let's get started. Number 1, why invest? I have 4 compelling reasons. Number 1 is long-term income. When you rent out your home or your apartment unit, you're most likely to get a 6, 9, or 12-month lease for that unit. You're going to get a minimum of 3 to 5 years on the lease, up to 15 to 20 years on the lease. So that equates to long-term income and long-term cash flow stability. Reason number 2, triple net leases. Investors love triple net leases. Here's how it works. An investor would buy a building and he would lease it out to a triple net tenant. What that tenant's going to do, that tenant's going to pay for all the expenses. He's paying for taxes, insurance, utilities, the roof, the parking lot, landscaping, everything. All you're paying for is the mortgage. So he's writing you, the tenant's going to write you 1 check per month. You pay the mortgage, the rest is yours. So there's no hassle, there's no maintenance, and that's as passive as it can get in real estate so far as investing. All right, so investors love it. You're going to find companies like Starbucks, CVS, and Walgreens are one of the more popular triple net lessees. All right. Number 3, the third reason to invest in office buildings is you may get a huge depreciation tax shelter. The beauty of real estate is to make money, but at the end of the year to pay no taxes because you have legally set up a tax shelter to help you offset the income you've made. You can literally make hundreds, $200,000, $400,000 and pay no taxes because of the tax write-offs, one of them being depreciation. When you purchase a single-family home rental and you have it for a while, you can write off the depreciation over 27.5 years. In commercial, you can write off that same depreciation but over 39 years. In addition to that, in commercial, you can write off over 5 years if you like. It's called chattel depreciation. You can write off your piping. You can write off your drapes, all the insides of your building. You can write off over 5 years. So, and you can accelerate it. So you can accelerate depreciation to pay even less taxes. That's the beauty. Number 4, strategic location. All right. Some properties, some office buildings have what we call a strategic location. If you were smart enough, and they were smart enough, and they bought a property in an area where the economy is flatlining or not doing so well, but they have the wherewithal to hold on to it, they are pretty much guaranteed a significant profit if they can hold on until the area comes back up. There's an individual here in Northern California where I live, and he did just that. When the tech boom ended here in the Bay Area, a lot of companies went under and office space was available everywhere. He virtually went under, but he barely held on. And then once the economy came back and boomed, he literally made hundreds of millions of dollars because of his strategic location. All right, okay, so I hope you understand 4 compelling reasons to invest in office buildings. The next topic is going to be the one big difference between office building investing and real estate, and residential real estate investing. I'll see you there. Number 2, the one big difference between office buildings and residential real estate or single family homes. In the office building, the value of it is a function of 3 things: income, tenants, and leases. As the income goes up on my office building, the value goes up. As I put in higher quality tenants, the value goes up. As I strengthen and put in high quality leases, the value goes up. Now if we go over to the residential, the single family home side, the value is, or the appraised value is not based upon whether this is occupied or vacant. All right, so whether the single family home is occupied or vacant, it's only worth what the appraised value is, as opposed to this side where it depends on the income, tenants, and leases. In fact, if this office building was empty, the value would be zilch. All right, almost not, maybe not zero, but close to it. Let me give you another example. Let's say that the CEO of Apple moved into this single-family home rental, and he was there for 5 years. The question is the property worth more because he lives there? The answer is no. All right. So the property is only worth what the appraised value is. All right. You do your sales comps around the area, you average it out. That's what this home is worth with him living there. However, if Apple Corporation leased out my office building and took it over, my income is going to go up because they're high paying renters. My tenant quality is through the roof because they're nationally recognized as one of the greatest tenants in the world. And my lease is going to be very, very strong because Apple's in there. All right. So that's the one big difference between office building and residential. Again, residential, whether it's occupied or vacant, makes no determination on its value. All right. As opposed to office, it does. Okay. Let's move on. Let's move on to office building basics. All right. Things you need to know. I'll see you there. Number 3, office building basics. Things you just have to know if you are a beginning office building investor. Let me start off by saying that out of all commercial real estate in the U.S., 20% of them are office buildings. However, that 20% is the most volatile asset class out of everything. What I mean by that is office buildings tend to go up and down more than anything else compared to apartment buildings, self-storage, industrial, shopping centers, mobile home parks. Office buildings seem to be the most volatile. And the reason why is, and you really have to understand this if you're a beginner, the reason why are 3 things. Number 1, the economy. Number 2, supply and demand. And number 3, the real estate cycle. Okay, so let's try to understand how all 3 are tied together and break them down. Number 1, the economy. All right, so when you're investing in an office building, you really have to understand the job growth and the economic growth in the area, right, in which the office building is located. In job growth, I want you to understand what jobs are available. However, not just any jobs. I'm talking white-collar jobs. White-collar jobs are office jobs and professional jobs. Not factory workers, not food service workers. These are white-collar jobs. Okay, again, office and professional jobs. You really have to understand what the job scene is like in that area. Secondly, economic growth. All right, so watch this. As the economy grows, all right, companies will tend to hire more workers, more full-time workers. They will need office space for those workers. All right, and hopefully it'll be your office space. And then, so as the economy grows, your business grows as an office investors. And likewise, if the economy shrinks, companies tend to lay off, all right, and they need less office space, and your income and your value of your property goes down as well. So it's really important that you understand both of these things. Where to get job data and economic growth data? Two places. You can go to the Bureau of Labor Statistics. Just Google that, all right, and just go and there's so much information there. And secondly, if you want to do a more direct approach, go to your local Chamber of Commerce, and they have a business development department in the Chamber of Commerce. And in that department, they have all of the job data and economic data that you can have. And most of it is even online, so check it out. Okay? All right. Number two, to really understand office basics and why office buildings are so volatile, all right, is to understand supply and demand. All right? And so when first understanding supply and demand in office buildings, you're going to ask yourself two questions. The first question is, what is the demand of what I'm currently want to invest in? All right. So if I want to invest in a government building, all right, I want to buy a government building and lease to the government, is there a demand in that area for that? All right. Secondly is, what's the supply of that in the area, right? Is there an oversupply? Is there an undersupply? All right. So you really need to understand those things. Well, to further break down supply and demand, you need to really understand three basic things. All right. Number one is the vacancy rate for the area. So in your area, what's the vacancy rate? How much space is unoccupied in the building? All right. Number two, absorption rate. What absorption rate is like a sponge. You want to absorb. So what an absorption rate is the ability of your marketplace of the office building to absorb, all right, new space as it comes on the market. Okay, it's as simple as that. So what is the rate of absorption? How long does it take for the market to absorb new space on the market? All right, third, local market supply. This is just research 101. You're going to have to pick up the phone and call some competitors and call other office buildings around the area and find out what their rates are, what they're offering, and what they do. All right, research 101. Thirdly, office building basics, and to really understand the volatility in office is to understand the real estate cycle. All right, we all know that residential real estate is on a cycle. We all understand that. The economy is on a cycle, right? So, but in office building, the cycle is a bit different. All right, watch this. Now, as the economy goes up, all right, as the economy goes up and down like this, all right, so does real estate, standard real estate cycle, right? Now watch this. So for office, as the economy goes up, let's say the office is here, let's say the cycle is here, office building cycle lags the economy cycle by about 4 to 5 months. All right, so even though the residential cycle here follows the economy, the office cycle it almost mirrors the economy cycle, except it lags the economy cycle by 4 to 5 months. Very important when you want to time the market and time your purchase. All right? Okay. Hope you understand now that office building basics, they're the most volatile class out of all the classes. All right? And the reason why is because these three things. So hopefully now you understand how all three are tied in. All right? Okay, so on the next video, I want to discuss the different types of office buildings. I'll see you there. Number 4, the different types of office buildings. But before I go there, I want to share with you an interesting fact. And that fact is the world's largest office building by floor space is the U.S. Pentagon in Virginia. Some of you may have thought it was the Empire State Building or some other building, but nope, it is the the U.S. Pentagon. It has about 6,500,000 square feet, and over half of it is used as office space. All right, so again, the world's largest office building by floor space is the U.S. Pentagon. All right, thought you'd like to know that. All right, let's get started here. The different types of office buildings. There are three different types basically. There's the high-rise, mid-rise, and low-rise. The high-rise is your typical skyscraper. You've seen those. Your mid-rise can go from 3 to 20 floors, and your low-rise can go from 1 to 3 floors. All right, and you've seen those buildings. Now, in between the high-rise and low-rise, there are these type of tenants in the office buildings. All right, so we have government offices, for example, where Social Security has their office. We have medical offices where doctors hold their practices. And we have business parks where corporations would have their companies. And R&D, research and development, where companies would do their research and development businesses inside those buildings. And office condos where you have the small businesses, just starting out. Startups will have office condos. Each space would be between 1,000 and 3,000 square feet, and they build out from there. That's why they call them condos. So they're basically one building parcelized into 10 different office condos. All right, okay, now comprised of from the high-rise to low-rise, from government to the office condos, we have building classes. As a beginning investor in office, you really must understand how to classify the office buildings. All right, there is the A class, B class, and C class. Let's go over them. A class are the trophy properties with the high rent. All right, these are properties where you drive down the road and you look up and they're beautiful, they're shiny, they're in the best neighborhoods, they're the highest quality tenants. Those are the A-class properties. They're the beautiful properties. Well, we don't want to play there. All right. So as a beginning investor, don't play with the A-class office buildings. These are for the REITs, for the real estate investment trusts, for the real estate investment funds, for the big dogs, for the big players. And most times they can put 50% down or pay all cash, and they're okay with the lower returns, and we're not. All right. So we don't want to compete against those guys because we can't. A step down from the A class is the B class. All right. So these are older properties. You still have good quality tenants. They're still in good areas. So as a beginning office investor, this is where I want you to play. I want you to play in this field in the B class. Now, what are you looking for in a B class? What you're looking for, this is ideal. All right. If you can find a B class office building, but in an A class area, that's good. That's awesome, because what you can do is you can upgrade the B class property, fix it up, put money into it, reclassify the tenants, and you can start charging A class rents or close to it. All right. So there's lots of upside if you can find a B class asset in an A class neighborhood. Got it? Okay. Next is C class. So C class is a step below B class. They're the oldest buildings. They're least desirable. They're probably not in the best neighborhoods. All right. So this is where, as a beginning investor, this is where I don't want you to play. C class office buildings are for what I call the value add investor. So these are investors that go in, they find ugly office buildings. They're going to probably empty it out, redo the insides, redo the outsides. So it costs a lot of money and time and expertise, something that a beginning office investor probably doesn't have. All right. So great upside here, great potential to make a lot of money here, but risky if you're just beginning. All right. Okay. So that's the different types of office buildings. You have the high-rise, the low-rise, government buildings down to office condos. And please understand the office classification A, B, and C. Okay, the next topic we're going to talk about is the 10 office terminology you need to know. I'll see you there. Number 5, 10 key office terms. These are terms that you need to know if you are a beginning office investor. Let's get started. Number one is the gross area. Gross area is the gross floor space of the office building. All right. Number two is the rentable area. This is the area, the floor space that is actually going to be rented. All right. We also can call this the gross leasable area. Sometimes you see this abbreviated as GLA. All right. Number three, price per square foot. This is the dollar figure you're going to charge a tenant per square foot. Number four, gross rent. What gross rents are is the figure that you're charging your tenant. Basically, it will be your price per square foot times your rentable area. That will equal your gross rents. Number five, lease types. The three most common types of leases are the gross lease, the modified gross lease, and the triple net lease. Those are three most common types. And in the next section, I am going to go into those in much greater detail for you. Number six, reimbursements. And depending on the lease, some landlords are entitled to get reimbursed for certain expenses. So in some of the leases, there will be a clause that says reimbursements, and in that clause would be which expenses are reimbursed to the landlord. Number seven, common area maintenance. This is a form of a reimbursement. It's commonly called CAM, a CAM charge, right? Common area maintenance charge. Basically, a landlord can be reimbursed for common area expenses such as repairs, hallways, lobbies, cleaning, things like that. All right? Number eight, tenant improvements, commonly called TI, tenant improvements. This is an allowance that the landlord gives the tenant when they are leasing out the place or renewing a lease. For example, a common tenant improvement could be putting up a sheetrock or drywall to separate buildings, to separate an office space, to put up a drop ceiling, to do something, to install something electrical. It could be a what we call a tenant improvement. All right, something that the landlord gives an allowance to, so actually the landlord pays for it. So it's a very important thing you have to understand. Number nine, operating expenses, right? All of commercial real estate has operating expenses, and this is probably one of the most important things to understand. In my experience, one of the things that new investors miss out on the most and miss out on the cash flow the most is by making a mistake of not calculating or what's the word I'm looking for? Underestimating the operating expenses in the building. So common operating expenses in an office building are just like other commercial real estate investments. You have insurance, taxes, property management, repairs, supplies, roof, things like that. Number 10, cap rate. All right, and in this video you heard me talking about cap rate. I mean, in this course or in all these other videos you hear me talking about the term cap rate. It is short for a capitalization rate. This is an industry term that's very important for you to understand. Basically, it is your net operating income divided by your sales price. The way I look at it is a cap rate gives you a percentage, and that percentage is what's your return on investment if you paid all cash for this investment. That's how I look at cap rate. All right, okay, so the next video I'm going to discuss leases. Leases are the lifeblood of any office building investment. I'll see you there. Number 6, the ABCs of leases for office buildings. The lifeblood of office buildings. All right, so in office buildings there are basically 3 types of lease agreements. There's going to be the gross lease, there's going to be the triple net lease. Triple net lease is also called the triple N, what you call it triple net, all right? So when you see it advertised anywhere, you will see 3 N's like that, all right? And then the third type of lease are the modified gross lease. Now, these are the 3 most common types of leases. There are other types, but for the sake of brevity today, we're going to talk about the three most common types of leases. Number one, the gross lease. The gross lease benefits the tenants the most. And the reason why is the tenant only has to pay rent, and the landlord pays for everything else. All the insurance, all the taxes, all the property management, all the security, all the repairs. Right? The landlord pays for all that. So it benefits the tenants the most in the gross lease. However, in the triple net lease, the exact opposite happens. The triple net lease benefits the landlord the most. All the landlord has to do is pay the mortgage, and the tenant pays for the taxes, insurance, property management, security, repairs, supplies, roofing, everything. This is why triple net is very, very popular amongst investors, because it's very passive. All you do is pay the mortgage, right, and you collect the what's left over every single month, while the tenant takes care of everything else. All right, modified gross lease. A modified gross lease is somewhere between the gross lease and the triple net lease. All right, so it depends on how you write it up. All right, so now you understand it. Three most common: gross lease, triple net lease, and modified gross lease. I'll leave you with a couple of tips. All right, the first tip is that when you are negotiating office space, when you are negotiating a lease, when you are negotiating renewal of a lease, please hire a professional. All right, the reason why is leases are the lifeblood of your investment. Don't forget that. You need to hire a professional to do something that's so important. In fact, a prominent author once told me that when you are buying an office building, Peter, what you are actually buying are the leases, and the building comes for free. Okay, so that's how important leases are. So hire a professional. All right, tip number two is that when you are negotiating a lease, or you're negotiating a renewal of a lease, everything is negotiable. Everything. All right, so never assume something is not negotiable. It is. Everything's negotiable. Okay, so the next thing I want to talk about today is the things to watch out for. All right, possible pitfalls and how to avoid them for office buildings. See you there. Number 7. Things to watch out for when investing in office buildings. I'm going to go with you some of the possible pitfalls. Now, there are risks involved with any investments, but these 4 are particular to office buildings. Okay, so number 1 is, what I want you to watch out for is to know that realtor rates go up and down with the economy. Back in the early 2000s, here in Silicon Valley, I saw realtor rates go down as much as 30% in a couple of years. And actually, when it drops that low, companies go out of business, and investors lose their property. So in the previous chapter, I discussed real estate cycles. So you really must understand the real estate cycles. So to avoid this pitfall, what I want you to do is monitor the real estate cycle when jumping in to an office building investment. Hopefully you can catch it on the down and ride the wave up towards prosperity. All right, number 2 is to watch for tenants with the largest square footage. Let's say that you have 2 tenants, and no, let's say you have 1 tenant who takes up 50% of the office space. The caution there is, what if that company goes out of business? Or just decide to not redo their lease, or they just decide to just move out. What do you do then? So you've lost half of your income possibly, and now can you weather the storm? So the one way to avoid this pitfall, to deal with it, is to have a reserve fund saved up for things like that. Because when someone like that moves out, you're going to have to be able to withstand the financial burden of paying the mortgage, insurance, and taxes, but also to be able to spend money on fixing up this empty space for the next tenant. All right. Number 3, expiring leases. Let's say you have an office building with 4 tenants, and all 4 tenants' leases expire this year. let's say in September, that's a very dangerous game to play. So what I want you to do to avoid this is to monitor the leases and try to stagger when the leases expire. Okay, stagger the months, but also, if you can, stagger the years in which they expire. Number 4, obsolescence. Just because you buy an office building at a very low price and you think it's a good deal, it could actually become a very bad deal in a couple of years. Let's say, for example, that your office building is in the area where high tech is booming, right? So, but it so happens that your building is so old that the electrical capacity of the building cannot be upgraded. It's too expensive to upgrade, and therefore you cannot take advantage of that high-tech boom. Your building is obsolete. All right, so again, these 4 are things I want you to watch out for. All right, so the next thing I want to talk about is possibly the most important thing when leasing to a tenant. I'll see you there. Number 8, possibly the most important thing to consider when choosing a tenant, and that is credit worthiness. And I'm not talking FICO scores here. I'm talking financial strength of the company. The stronger the company is financially, all right, the less risk you're going to have. If the company isn't strong financially, it's a lot more risk when you invest in that building. Another way of looking at it is with cap rates. The stronger the company, the lower the cap rates. The weaker the company, higher the cap rates. Let me give you another example in a different way. Let's say we have 2 office buildings here. So one is office building has a Starbucks, other office building has a mom and pop groceries. All right. So let's say they're identical square footage, all right, and also identical rent. Let's say you're getting, $10,000 a month rent here, and you're getting $10,000 a month here, all right? So same rent, same square footage, same area, the buildings are next door, built in the same time, all right? So identical buildings, just one has Starbucks, and one has mom and pop groceries. Let's say the respective owners decide to put their properties on the market. The question is, which of these buildings will get a higher price? Which of these buildings will be more desirable for investors? And which of these buildings will sell quicker? The answer is easy. The answer is Starbucks, because they are a nationally known nationally known company, and they're worth $1 billion. So they're good for their leases. They can perform and even outperform their leases. As opposed to the mom and pop groceries, well, they're not nationally known, and this is risky because they are mom and pop. Let's say that Starbucks has 3 years left on their lease, and decides to close this location. All right, because they are Starbucks and they have 3 years left on their lease, you can count on Starbucks to guarantee their lease for the next 3 years. So you'll still be getting a check every 3 years, even though this building is empty. On this side, mom and pop groceries, if they have 3 years left on their lease and they shut doors, you're out of luck. They're just insolvent, and you can chase them all you want, but you're out of luck. You're not going to retrieve anything here. All you're going to have here is an empty building with no money coming in. All right, so the next question is, how do you check a company's creditworthiness? 2 ways. All right, 2 ways to check. Number 1 is if it's a private company or a publicly traded company, you can go to Dun & Bradstreet, and or the website here is dnb.com. If it's a publicly traded company, you can go to the Standard & Poor's credit rating website, which is called standardandpoors.com. So you can go there if it's a publicly traded company, and you can check out a company's financial strength and their credit worthiness. All right, so the last thing I want to share with you today is what's happening in office, the trends. What are the trends for today and tomorrow? All right, so I'll see you there. And lastly, number 9, the future of office buildings. Where is office headed? So in this short section, I'm going to share with you what I see the top 3 trends. So have you noticed that music stores are disappearing, video stores are nearly gone, and one of my favorite places to hang out, bookstores, they have all nearly closed up. I'm also seeing mall designs change drastically as well. So I'm wondering, maybe you're wondering, what changes do you see in office buildings? Are office buildings going to close down and everyone just commutes and just works from home? Well, the answer is no. We will always need office building and office workers in some way, shape, or form. So office buildings are not going to go away. However, they are constantly evolving and changing. So let's go over the top 3 trends I see today. Number 1, I see workplace density changes. What I'm seeing is for a given floor space, I'm seeing more workers. So I'm seeing higher density of workers in a given workspace. In fact, here's a stat for you. Today, an average company has dedicated 185 square feet per office worker, and 10 years ago that was 250 square feet per office worker. So that trend will continue, and office space will be shrunken or more densified. So you can say goodbye to private offices for many people, as well as the corner offices. All right. So number 2 is the untethering of office workers. What I mean by that is, what I'm finding is 30 to 40% of a dedicated workspace is vacant in a given day. All right. So where is that employee going? Well, what causes that are mobile devices. Actually, smartphones, tablets. They're able to carry laptops, and these employees are actually untethering themselves away from an office space and working in a break room, working in a conference room, working someplace around and near their building. So this causes the company to have substantial savings and much greater space utilization. All right. Number 3, telecommuting is out and collaboration is in. All right. So recently, Yahoo Corporation nearly stopped all telecommuting in their company. Not only do they want everybody in the office, but they want them in an open space, more of a collaborative environment, much like a small company, so they can make decisions more rapidly and work together and better as a team. All right, so if you are a beginning office investor, it's really important that you pay attention to what these trends are. All right. Thank you for watching this video. I'm all done here. And if you want more videos like this, please go to our website, commercialpropertyadvisors.com, or simply subscribe to this YouTube station. Thank you for watching Office Investing for Beginners. I'll see you at the next video.